The market is full of people who can explain patterns, indicators, and strategies. They can tell you where support is, where resistance is, and why a setup should work, yet their accounts keep disappearing. So what is happening? Have you ever noticed that your worst losses rarely come from your first decision? They come from the decisions that follow it. A trade goes against you. You feel uncomfortable. Then you add more size. The loss grows. Now you're not trading the market anymore. You're trading your emotions. The account doesn't blow up in a single trade. It blows up through a chain of reactions. And that's the part most traders never study. The market itself is not emotional. It moves based on supply and demand. But the trader sitting behind the screen brings fear, hope, impatience, and ego into every decision. When those emotions start influencing position size, entries, exits, and risk management, the outcome becomes almost predictable. Why does a trader suddenly double their size after a loss? Why do they abandon a plan they've followed for weeks? The answer isn't confidence. It's discomfort. Most account blow-ups begin when a trader starts trying to eliminate discomfort instead of managing risk. Think about it. When you take a small planned loss, the pain is limited. But when you refuse that loss, you create a bigger problem. The bigger problem creates more emotional pressure. More pressure leads to worse decisions. Worse decisions create larger losses. Cause and effect. The market punishes emotional reactions because emotional reactions distort judgment. Now here's the dangerous part. The trader often feels most certain right before the account suffers the most damage. Have you noticed that? After a few wins, discipline starts to fade, risk starts expanding, rules become suggestions. A trader begins believing they can predict instead of react. That shift is subtle, but it's expensive. The market doesn't care how strongly you believe. It only responds to what actually happens. So what should you watch for? Pay attention to moments when you feel an urgent need to make money back. Watch for the desire to increase size after losses. Notice when you're looking for reasons to stay in a trade instead of reasons to evaluate it objectively. Those moments matter. They're not signs of opportunity. They're warning signs. A professional trader isn't defined by how much they make when conditions are favorable. They're defined by how they behave when conditions are unfavorable. Can you stay patient when nothing is happening? Can you accept being wrong without needing immediate revenge? Can you sit through boredom without inventing trades that don't exist? Those questions determine survival far more than any indicator ever will. The goal is not to avoid losses. Losses are part of the business. The goal is to avoid emotional decisions that transform ordinary losses into catastrophic ones. Because every blown account follows a familiar path. First comes impatience. Then comes oversized risk. Then comes the belief that one trade can solve everything. And once a trader starts looking for one trade to rescue them, they're no longer thinking like a risk manager. They're thinking like a gambler. Most traders believe bad trades are what destroy accounts. They think the problem is entering at the wrong price, misreading the chart, or getting caught on the wrong side of a move. But that's not usually what causes the damage. In fact, some of the biggest account blow-ups begin with good trades. That sounds strange, doesn't it? How can a good trade become the reason a trader loses everything? Because success changes behavior. A losing trade usually makes traders cautious. A winning trade often does the opposite. You catch a strong move. The setup works exactly as expected. The market rewards you. Confidence rises. Nothing wrong with that. The problem starts when confidence quietly turns into certainty. Have you ever noticed how disciplined you are before a trade, but how relaxed you become after a few winners? At first, every rule matters. Position size is controlled. Risk is calculated. Entries are selective. Then the wins start stacking up. Suddenly, opportunities seem easier to find. Setups that weren't good enough yesterday suddenly look acceptable. Trades that should be skipped somehow find their way into your account. Why? Because the brain starts associating recent success with future success. A trader begins feeling smarter than they actually are. The market hasn't changed, but the trader has. And that shift is dangerous. The biggest losses often don't happen when traders feel uncertain. They happen when traders feel convinced. When someone is unsure, they hesitate. They double-check. They manage risk. When someone feels certain, they stop asking questions. That's when position sizes increase. That's when stop losses become optional. That's when risk starts expanding without the trader even realizing it. Think about what happens after a series of profitable trades. The account balance grows. The trader feels comfortable. The pressure disappears, and comfort creates a new problem. It lowers vigilance. The trader starts believing the recent results are proof of skill rather than a combination of skill and favorable market conditions. Can you see the trap? A good trade creates confidence. Confidence creates larger risk. Larger risk creates vulnerability. Then one normal losing trade arrives. Not a disaster, not a market crash, just an ordinary loss. But now the position size is much bigger than before. The loss hurts more. The trader wants the money back. So another trade is taken. Then another. Now the emotional cycle begins. What's interesting is that none of this starts with a bad trade. It starts with a good one. A winning trade convinces the trader that rules are less important than they really are. The market rewards behavior that shouldn't be rewarded, and the trader learns the wrong lesson. That's why a reckless winning trade can be more dangerous than a disciplined losing trade. A disciplined loss reinforces proper behavior. A reckless win reinforces bad habits. Which one do you think causes more long-term damage? Most traders focus on outcomes. Professionals focus on decisions. They understand that a profitable trade isn't automatically a good trade, and a losing trade isn't automatically a bad one. What matters is whether the process was sound. If you risked too much, ignored your rules, and still made money, the market didn't validate your decision. It simply delayed the consequence. That's an important distinction, because delayed consequences are what trap traders. The account doesn't immediately punish the mistake, so the mistake gets repeated, and repeated, and repeated again, until one day the market stops being forgiving. Then the trader is shocked. They wonder why everything changed. But nothing changed. The behavior was flawed from the beginning. The winning trades simply hid it. This is why experienced traders pay close attention after periods of success. Not because they're afraid of winning. Because they understand that success can create carelessness. The danger isn't making money. The danger is what making money convinces you to do next. A trader who survives for years learns a simple lesson. Every winning streak carries risk. Not market risk, psychological risk. The risk of believing that recent profits have somehow changed the laws of risk management. The risk of thinking you're seeing the market more clearly than everyone else. The risk of forgetting that the same discipline responsible for the profits is the only thing that can keep them there. Most traders think they are fighting the market. They believe their challenge is finding better entries, predicting bigger moves, or discovering a strategy nobody else knows. But if you watch traders closely, you'll notice something different. The market isn't usually their biggest problem. Their need to be right is. Have you ever held a losing trade longer than you planned because you were convinced the market would eventually prove you correct? Almost every trader has. The strange part is that the market never asks you to be right. It only asks you to manage risk. Yet many traders approach every position as if it's a test of intelligence. A trade becomes more than a trade. It becomes a personal prediction. And once that happens, emotions become attached to the outcome. Now the trader isn't just protecting capital. They're protecting their ego. That's where the trouble begins. Because the moment your identity becomes connected to a trade, objectivity starts disappearing. A small loss no longer feels like a business expense. It feels like a personal defeat. So what happens? The stop loss gets moved. The position gets justified. New reasons are found to stay in the trade. Information that supports the position gets accepted. Information that challenges it gets ignored. The trader isn't analyzing anymore. They're defending. Think about how many traders spend hours searching for confirmation after entering a position. Why do they do that? If the trade is already planned and the risk is already defined, what are they really looking for? They're looking for reassurance. They're looking for proof that they're right. The market doesn't reward that behavior. In fact, it often punishes it. Because the need to be right creates rigidity, And rigidity is dangerous in an environment that constantly changes. The best traders are not attached to opinions. They are attached to evidence. That's a major difference. When new information appears, they adjust. When conditions change, they adapt. When they're wrong, they accept it quickly. Why? Because they understand something many traders never learn. Being wrong costs money. Staying wrong costs far more. A trader who needs to be right will often hold losers and sell winners. Think about that. The losing position becomes a mission. The winning position becomes something to protect. The result is predictable. Losses grow larger than they should. Profits become smaller than they could be. And over time, the math becomes impossible to overcome. What's interesting is that this behavior rarely feels irrational in the moment. It feels reasonable. The trader tells themselves they're being patient. They say they're giving the trade room to work. They convince themselves the market is temporarily confused. But beneath all those explanations is often a simple desire. The desire to avoid admitting they were wrong. Have you noticed how difficult it can be to close a losing trade the moment your plan says to exit? The financial loss may be small, yet the emotional resistance feels enormous. That's because the mind naturally wants consistency. Once you've committed to an idea, changing your mind feels uncomfortable. The market takes advantage of that weakness every day. It doesn't care about your analysis. It doesn't care how much time you spent preparing. It doesn't care how strongly you believe. Price moves according to supply and demand, not conviction. The sooner a trader accepts that reality, the more freedom they gain. Freedom from needing every trade to work. Freedom from forcing opinions onto charts. Freedom from turning ordinary losses into major setbacks. Professional traders understand that losses are not evidence of failure. They are evidence of participation. You cannot engage with uncertainty and expect certainty in return. That's not how markets work. The goal is not to prove your intelligence. The goal is not to win every argument with price. The goal is to preserve capital long enough for probabilities to play out. And probabilities require flexibility. The moment you become emotionally committed to being right, you stop responding to what the market is actually doing. You start responding to what you wish it would do. And the distance between those two things is where most trading damage occurs. Because every major trading mistake usually begins with a simple thought. This market has to come back. This trade has to work. I know I'm right. Most traders don't blow up their accounts in a single dramatic moment. They don't wake up one morning and decide to ignore every rule they've ever learned. The process is much quieter than that. It usually begins with one small rule violation. Something that seems harmless. Something that feels justified. Something the trader promises will only happen this one time. Have you ever taken a trade that wasn't quite part of your plan, but you convinced yourself it was close enough? That's how it starts. Not with recklessness, with permission. The trader gives themselves permission to bend a rule. Maybe the entry was early. Maybe the position size was slightly larger. Maybe the stop loss was wider than usual. Nothing catastrophic. At least not yet. The trade might even work. In fact, that's often the worst outcome. Why? Because success can make a mistake feel acceptable. The trader breaks a rule and gets rewarded. Now the mind learns a dangerous lesson. It learns that discipline is optional. Once that idea takes hold, the next violation becomes easier. The line that once seemed clear begins to move. A trader who would never risk 2% suddenly risks 3%. A trader who would never move a stop loss suddenly moves it a little. A trader who would never average down suddenly adds to a losing position. Each decision feels small. Each decision feels manageable. But the account doesn't experience them individually. The account experiences them collectively. That's where the danger lies. Most traders focus on the size of mistakes. Experienced traders focus on the frequency of mistakes. Because repeated small violations eventually become a habit, and habits determine behavior under pressure. Think about what happens when a trade starts moving against you. Your emotions rise. Stress increases. Decision-making becomes harder. In those moments, you don't suddenly become disciplined. You fall back on your habits. If your habit is respecting rules, you'll likely manage the situation correctly. If your habit is making exceptions, you'll start making more exceptions. Pressure doesn't create character. It reveals it. That's why small rule violations matter so much. They're not isolated events. They're rehearsals. Every time you ignore a rule, you're practicing ignoring it again. Have you noticed how traders often explain away their mistakes? They'll say, "That was only one trade," or "I had a strong feeling," or "the setup looked obvious." The explanation changes, but the behavior remains the same. The trader keeps teaching themselves that rules can be negotiated. And once rules become negotiable, risk becomes unpredictable. The market doesn't punish every mistake immediately. That's what makes this so dangerous. If every rule violation caused an instant loss, traders would stop doing it. But markets don't work that way. Sometimes bad decisions make money. Sometimes poor risk management gets rewarded. Sometimes reckless behavior looks brilliant for a while. The problem is that traders start measuring decisions by outcomes instead of process. A rule is broken. The trade wins. The trader feels smart, but nothing has actually improved. The risk is still there. It's simply hidden. Then one day conditions change. The market becomes less forgiving. The same behavior that produced profits starts producing losses, and now the trader is carrying a collection of bad habits built over months or even years. That's why account blowups often seem sudden from the outside. People look at the final loss and assume that's where the problem began. It wasn't. The blowup started much earlier. It started with the first exception. The first ignored rule. The first moment a trader decided discipline could wait. By the time the account suffers serious damage, the underlying behavior has usually been developing for a long time. The final loss is often just the bill arriving. Professional traders understand this. They don't wait for large mistakes before becoming concerned. They pay attention to small deviations. They notice when they're entering early. They notice when they're increasing size unnecessarily. They notice when they're searching for excuses instead of following procedures. Why? Because they know that consistency is fragile. A small crack in discipline rarely stays small. It expands. One exception creates another. One shortcut creates another. One emotional decision makes the next emotional decision easier. And before long, the trader is no longer following a system. They're following whatever feels right in the moment. The dangerous part is that this transition happens so gradually that most people don't notice it. They believe they're still the same disciplined trader they were months ago. Meanwhile, their standards keep slipping. Their rules keep softening. Their risk keeps expanding. Most traders blame the market for their losses. They blame volatility. They blame manipulation. They blame unexpected news. They blame large institutions. And while markets can be difficult, that's usually not what destroys accounts. The market creates situations. The trader creates the reaction. And that reaction is often where the real damage happens. Think about it. Two traders can see the exact same chart, experience the exact same price movement, and end up with completely different outcomes. How is that possible? Because the market affects everyone equally. But people respond differently. One trader accepts the loss and moves on. Another trader becomes frustrated and immediately enters a new position. The market didn't create the second mistake. The reaction did. That's an important distinction. Most account blowups are not caused by a single bad market move. They're caused by a chain of emotional decisions that follow it. A trade loses money. The trader becomes irritated. Irritation creates urgency. Urgency creates impulsive decisions. Impulsive decisions create larger losses. Larger losses create even stronger emotions. And the cycle continues. Notice what happened. The original loss wasn't the real problem. The response to the loss was. Have you ever taken a trade simply because you wanted to recover from the previous one? Not because the setup was excellent. Not because the conditions were ideal, but because being down money felt uncomfortable. That's one of the most common reactions in trading. The mind wants balance. When a loss creates emotional discomfort, the natural instinct is to remove the discomfort as quickly as possible. The trader mistakes emotional relief for opportunity, and that's where trouble begins. Because markets don't reward emotional needs. They reward discipline. A trader who needs to win becomes vulnerable. A trader who needs to recover becomes vulnerable. A trader who needs to prove something becomes vulnerable. The market doesn't destroy them. Their reactions slowly do. What's interesting is that reactions are often invisible while they're happening. Most traders don't think, "I'm making an emotional decision." They think they're being logical. They find reasons. They create explanations. They justify behavior. The emotional decision gets wrapped inside a rational story. That's why self-awareness is so important. You have to learn to recognize your own patterns. What happens after a losing streak? What happens after a big win? What happens when a trade misses your target by a few points? Do you remain objective? Or do your decisions begin changing? Because every trader has emotional triggers. The question isn't whether they exist. The question is whether you recognize them before they affect your behavior. The market has a unique way of exposing emotional weaknesses. If you're impatient, it will tempt you into forcing trades. If you're fearful, it will make you hesitate when opportunity appears. If you're overconfident, it will encourage excessive risk. The market simply presents the situation. Your reaction determines the outcome. That's why two traders can use the same strategy and produce completely different results. One follows the process. The other reacts to every emotional fluctuation. The difference isn't knowledge, it's behavior. Have you noticed that many traders know exactly what they should do? They know where to place stops. They know how much to risk. They know when to stay out of the market. Yet they still fail. Why? Because knowledge and execution are not the same thing. The challenge isn't learning the rules. The challenge is following them when emotions are involved. Anyone can be disciplined when nothing is at stake. Discipline becomes valuable when pressure appears, and pressure reveals reactions. This is why professional traders spend so much time managing themselves. They understand that success isn't about controlling the market. That's impossible. Success comes from controlling how they respond to the market. They don't waste energy wishing price would behave differently. They focus on behaving correctly regardless of what price does, because the market will always produce uncertainty. It will always create winning streaks and losing streaks. It will always move in ways that surprise people. None of that is unusual. What's unusual is how traders respond. Some respond with patience. Others respond with frustration. Some respond with discipline. Others respond with impulse. And over time, the gap between those reactions becomes the gap between consistency and account destruction. Because when traders look back at their biggest losses, they often discover something surprising. The market delivered the first punch. Most people assume intelligence is an advantage in trading, and in many ways it is. The ability to analyze information, recognize patterns, and understand complex ideas can certainly help. But there's a point where intelligence stops helping and starts hurting. That sounds strange, doesn't it? How can being smart become a weakness? Because markets don't reward intelligence in the way most intelligent people expect. In school, intelligence is rewarded. You study hard, find the correct answer, and receive a good result. In most professions, expertise leads to greater control. The more you know, the more predictable outcomes become. Trading doesn't work like that. The market doesn't care how intelligent you are. It doesn't care how much research you've done. It doesn't care how convincing your analysis sounds. Price can still move against you. And that's where highly intelligent traders often run into trouble. They're used to solving problems. They're used to being correct. They're used to finding answers. So when a trade starts failing, their first instinct isn't to accept uncertainty. It's to outthink it. Have you ever noticed how easy it is to find another reason to stay in a losing trade? A smart trader can always find one. In fact, they can find 10. The more intelligent the trader, the more sophisticated the justification often becomes. What starts as a simple losing position turns into a complex argument. New data gets analyzed. Alternative scenarios get created. Additional explanations emerge. The trader becomes increasingly convinced that the market is wrong. But the market doesn't care about arguments. It only reflects reality. This is where intelligence can become dangerous. It gives traders the ability to defend bad decisions long after they should have abandoned them. Instead of admitting the trade isn't working, they build a stronger case for why it eventually will. The trade changes. The thesis changes. The evidence changes. But the position remains. Why? Because accepting uncertainty feels harder than finding another explanation. Think about the difference between intelligence and wisdom. Intelligence often seeks certainty. Wisdom learns to operate without it. Many intelligent traders spend years trying to eliminate uncertainty from an environment built on uncertainty. They search for the perfect indicator, the perfect strategy, the perfect confirmation, the perfect explanation. And every time they think they've found it, the market reminds them that certainty is an illusion. Have you noticed how some of the smartest people struggle to take small losses? It's not because they don't understand risk. It's because the loss challenges their self-image. If intelligence has always helped them solve problems, then being wrong feels unfamiliar, uncomfortable, even threatening. As a result, they start negotiating with reality. The stop loss gets moved. The position gets adjusted. The original plan gets rewritten. Not because the market changed, because their need to be correct became stronger than their willingness to be objective. The irony is that less intelligent traders sometimes avoid this trap. They don't overanalyze. They don't create elaborate explanations. They simply follow the rules. And in trading, simple discipline often beats complex reasoning. That's difficult for many intelligent people to accept. They want every outcome to make sense. They want every loss to have a clear explanation. They want every move to be understandable. But markets frequently do things that don't make immediate sense. Can you accept that? Can you remain disciplined when the market contradicts your analysis? Can you exit a trade even when you're still convinced your idea is right? Those questions matter far more than most traders realize. Because the market isn't testing your intelligence, it's testing your flexibility, the ability to change your mind, the ability to abandon an idea, the ability to accept new information without becoming emotionally attached to old conclusions. Highly intelligent traders often believe their greatest strength is their ability to think deeply. Sometimes it is, but sometimes their greatest strength quietly becomes their greatest weakness. The deeper they think, the more reasons they find. The more reasons they find, the harder it becomes to let go. The harder it becomes to let go, the more risk they carry. And eventually, what began as intelligence transforms into stubbornness disguised as analysis. The fastest way to lose money in trading is not taking a loss. It's trying to get it back. Most traders don't realize this at first. They believe the danger is the losing trade itself. But a single loss rarely destroys an account. What usually causes serious damage is what happens immediately afterward. A trade fails. The stop loss gets hit. The market moves on. The loss is over, at least financially. Emotionally, it's often just beginning. Have you ever noticed how a loss feels different when it happens unexpectedly? You weren't prepared for it. You were confident. The setup looked perfect. Everything seemed aligned. Then the market disagreed. Now something changes. The trader stops thinking about the next good opportunity. They start thinking about the money they just lost. And that's where the problem begins. The focus shifts from execution to recovery. At first, the change is subtle. The trader isn't necessarily trying to gamble. They're simply trying to get back to where they were a few minutes ago. That sounds reasonable, doesn't it? But markets don't reward reasonable feelings. They reward disciplined actions. The moment your goal becomes recovering losses instead of following your process, you're operating from a different mindset. You're no longer asking, is this a quality trade? You're asking, can this make my money back? Those are two completely different questions. One protects capital. The other puts capital at risk. Think about what happens psychologically after a loss. The account balance drops. The mind immediately compares the new balance to the old one. A gap appears, and people naturally want to close gaps. The discomfort creates urgency. Urgency creates impatience. Impatience creates poor decisions. Cause and effect. The sequence is almost always the same. A trader takes a loss. Then they lower their standards.